New York City, October 1929. The streets were not yet filled with panic. There were no screaming traders, no collapsing banks, no breadlines. There was confidence. Stock tips circulated in barbershops. Taxi drivers offered portfolio advice. Leverage was abundant. Credit was easy. Newspapers celebrated a new era of permanent prosperity. The collapse did not begin with fear. It began with certainty, and that pattern has repeated itself in every major economic breakdown since. The myth is that collapses begin when people panic. In reality, panic is the final stage. The true beginning is far quieter and far more dangerous. It begins with structural distortion. To understand this, we need to break the illusion. Every major financial collapse follows a predictable sequence. It is not random, it is not mysterious, it is structural, and it unfolds in 5 stages. The era of stability. Every collapse begins with genuine prosperity, strong growth, expanding credit, technological innovation, rising asset prices. In the 1920s, it was electrification and industrial expansion. In the late 1990s, it was the internet. In the early 2000s, it was housing. In the 2010s, it was low interest rates and tech dominance. Stability creates trust. Trust lowers perceived risk. Lower perceived risk encourages leverage. This is where the seed is planted. Because stability changes behavior. Investors move from caution to confidence, then from confidence to assumption, and finally from assumption to entitlement. Returns are no longer earned, they are expected. The credit expansion, every collapse is preceded by one measurable shift. Credit expands faster than underlying productivity. This is the silent beginning. Banks loosen standards. Lending accelerates. Asset prices rise not because of fundamentals, but because of liquidity. In 1929, margin debt surged to unprecedented levels. In 2008, mortgage-backed securities multiplied beyond comprehension. In 2021, global debt reached record highs while rates hovered near zero. Credit expansion feels like growth, but it is borrowed growth from the future. When credit grows faster than real economic output, the system becomes fragile. It looks strong, it feels strong, but it is dependent on constant expansion. The moment credit growth slows, the illusion begins to crack. Asset inflation, disguised as prosperity. Here is the myth-breaking moment. Rising asset prices are not the same as rising wealth. When stocks soar because money is cheap, when real estate doubles because lending is easy, when valuations detach from earnings, it creates the appearance of prosperity. But this is valuation expansion, not productivity expansion. In 2006, homeowners believed they were wealthier. In 1999, tech investors believed a new economic law had been written. In 2021, speculative assets reached valuations untethered from cash flow. Paper wealth expands, confidence expands with it, but the foundation becomes increasingly narrow. Concentration of risk as booms mature. Risk concentrates. It concentrates in specific asset classes, in specific institutions, in specific narratives. Before 1929, it was margin speculation. Before 2008, it was housing and structured credit. Before Japan's 1990 crash, it was real estate and equities trading at historic multiples. The public rarely sees this concentration clearly because rising prices mask structural weakness. Institutions become interconnected. Leverage layers upon leverage. Liquidity becomes assumed. This is the most dangerous stage because nothing appears wrong. In fact, everything appears strong. The trigger, not the cause. Eventually, something small happens. A rate hike, a liquidity squeeze, a policy mistake, a default. The trigger is rarely catastrophic on its own. But when a system is saturated with leverage and inflated valuations, Small shocks produce large consequences. The trigger is not the cause. It simply reveals the imbalance that has been building for years. In 1929, tightening credit exposed margin fragility. In 2008, subprime defaults exposed systemic leverage. In 2022, rising rates exposed overextended growth valuations, and only then does panic begin. Panic is the consequence, not the origin. Modern relevance today, many investors search for signs of panic, volatility spikes, media fear, dramatic headlines. But those are late signals. The earlier signs are quieter: debt growing faster than GDP, asset prices rising faster than income, valuations stretching beyond historical norms, risk concentrating into fewer dominant trades, policy dependence becoming structural. The collapse never starts when people are afraid. It starts when people believe collapses are no longer possible. This is why cycles repeat. Human psychology does not change. Access to credit changes, technology changes, instruments change, but belief in permanence returns every generation, and permanence is always temporary. The structural framework to recognize early fragility. Watch these 5 structural indicators. Credit to GDP acceleration, asset valuation relative to historical earnings, liquidity dependence on central bank policy, leverage embedded in financial institutions, narrative dominance, when one story explains everything, when all 5 align. Vulnerability is elevated, not because collapse is guaranteed, but because resilience is reduced. The quiet truth: economic systems do not collapse from noise. They collapse from imbalance, and imbalance grows in silence. By the time headlines scream recession, market crash, or economic collapse, the structural distortion has already matured. The disciplined investor does not react to panic. They study structure. They understand that true wealth preservation is less about predicting the exact trigger and more about recognizing when foundations are thinning. History does not repeat perfectly, but it rhymes structurally. And in every era, the collapse begins the same way, with optimism, with easy credit, with expanding valuations, with confidence in permanence. The lesson is not to fear prosperity, it is to question excess. Because the most dangerous moment in any cycle is not when markets fall, it is when they feel invincible. And the collapse, when it comes, never starts with panic. It starts long before that, in silence.